Morgan Stanley's John Glass debuted on the All-America research team in 2005, and he has made the team every year since. This year marks his 5th straight appearance at #1 in restaurants. His sector has been the focal point of recent protests over the minimum wage. The issue is not going to go away, the analyst says, but companies have many opportunities to adapt.
Wages are going up in the United States, whether it's the state governments, whether it's city governments, or the federal minimum wage increase. And so restaurants really have to manage around that. It is the most important input cost besides food costs in a restaurant. So, we project that minimum wage is going to go up even just if states do what they plan to do over the next several years by a high single-digit growth rate. And that's not really going to abate. So you have to be smarter about managing your personnel. I think, on the other hand, cutting wages or cutting hours doesn't make sense, right? It's a very operationally sensitive business. So good companies are going to have to look for other ways to get around it to make the bottom line. Burger King's acquisition of Tim Hortons actually is the largest transaction in restaurant M&A in history. So it's significant in that respect. It's also significant in that Burger King, which is essentially controlled by 3G, which is a Brazilian fund, has made some interesting and unique changes to the way they run that business. They're very conscious of costs, so there's a much lower G&A expense than what we would expect in restaurants. They're very aggressive in their growth plans, and I think they're ultimately very shrewd managers of business. So they are coming in from the outside and actually changing the way this industry is run, and I wouldn't be surprised to see other companies have to react to that in their own business models. I don't think it necessarily means there's going to be a significant amount of other M&A in the restaurant space. I think this was a unique opportunity, but as we've said in our research, we think that Burger King could ultimately end up being a platform company that acquires other restaurants in the future. So restaurants performed, first of all, really well. 2013, they were up 50% in aggregate, and a lot of that was multiple expansion. 2014, year to date, they're down a little bit, so they've underperformed the market. I think that's just a function of where they were in 2013. I think it's going to be much more company and stock specific than it is the whole sector. We're still seeing a very sluggish consumer, and as a result, restaurant sales have been somewhat sluggish year to date. Fast casual has been the fastest growing category within restaurants for several years now, but it's finally getting to the size to a size that matters to investors, and there's enough companies and market cap in the space. So that's everything from Chipotle to Panera to some of the newer IPOs in restaurants. It really works with the way people eat today, right? They want high quality food. There's much more focus on the quality of food they're eating, and at a reasonable price, and I think more importantly, a reasonable time frame. Sitting down for a full service meal today is more of a luxury than a lot of people can afford, even if they had the money. The casual dining business has been under secular pressure for a number of years. Now, it's not to say that good operators can't adjust the business models to current times. But if you think about it, casual dining was an industry that was built for the baby boomers. That cohort in the population is starting to wane in size. The next generation below them isn't as big, so there aren't as many new entrants from consumers' perspective into the category as there are exiting it. So they're going through a secular challenge. We've also documented over years the overbuilding in that industry. Having said that, right, there are a number of companies that are beginning to change their business model, beginning to reflect the new reality of more of a price focus on the top line, trying to use franchising to protect the margins on the business if the industry is under more price competition. So, the industry has to change. I think it's in the throes of those changes, and we'll come out a much healthier and stronger industry. But that's the one that's probably the most secularly challenged.